From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 20th, 2024. Checking the calendar. Your division-winning Milwaukee Brewers welcome the Arizona Diamondbacks to town for the weekend, and the Packers are in Tennessee with the Titans Sunday at noon. Waukesha is doing Oktoberfest this weekend at Frame Park, and a little closer to the lake, the Bavarian Beer House is also doing Oktoberfest for the next few weekends. I feel like a beer and a pretzel. Okay, here we go. Delta Airlines is updating its dress code for its employees, but mostly for flight attendants. They're expected to return to their natural hair color. No purples, no greens, etc. They were also asked to wear proper underwear. Underwear that's not visible. My question is, where do you buy invisible underwear? I don't think even Victoria's Secret has invisible underwear. Well, going vegan isn't as easy as it used to be. Just giving up meat. No, there's more to it than that. Vegandale is a vegan food and traveling music festival. Just one problem in meat-eating Chicago. They didn't know how many people were to show up. Tens of thousands showed up. Some of the lines were 90 minutes long before they ran out of food, and a porta potty overflowed. Vegan or not, that's going to leave a bad taste in your mouth. And finally, not from Florida, an 8-year-old girl in Ohio jumped into the family SUV and drove herself to a Target that was 10 miles away. She was on a mission to buy herself some birthday presents. When the cops found her, she was at the coffee bar at Target sipping a Frappuccino. Did I mention she's 8 years old? Between timeouts and filming, she's filming the next Fast and Furious movie. On the podcast today, we have John Sandstrom, Joel Driesang, Art Rothschild, and with a look back at the week, here's Kyle Teding.
Well, thanks, Max, and a good week it was. The Nasdaq up 1.5% this week, closing at the bell 17,948. The S&P up 77 points this week, up 1.4%, closing at 5703. And the Dow Jones Industrial Average added 37 points on Friday, up 1.6% for the week to close at 42,062 for the year. Nasdaq up 20.1%. The S&P up 20.7%, and the Dow Jones Industrial Average up 13.1%, all including dividends. John, I think we'd be remiss if we didn't start with the Fed this week. I know you tuned into Jay Powell's comments after the Fed announcement. What did we learn?
You know, there's a lot to unpack from that press conference. Lots of different questions kind of reaching to all different parts of the market and kind of what the Fed thinks. So, obviously they cut the 50 basis points this past week, first time in quite a while. And Powell really had a lot to say about inflation, kind of the confidence that the Fed has, that the 50 basis points kind of came from the fact that they're at the point now where they think inflation is at a spot that's under control. And they think that it's going to continue to move down to their 2% target, and that's what gave them the confidence to make this 50 basis point cut. He also went out of his way to make sure that he said that this cut is not necessarily because they foresee turbulence in the economy, which is typically what people associate with these rate cuts. It's more of a show of confidence, like I said, in inflation and a return to stability in rates. He did admit that the labor market has kind of softened a little bit, but 4.2% unemployment is still very healthy by any means. And then he also went on to say that moving forward, and this is kind of how Powell's been the entire time, that these decisions are made meeting by meeting. It's not something where they're going to be forecasting, this is how many cuts we're going to do, this is what you can expect. They're going to look at the data in between each meeting and make decisions based off of where the economy is.
Of course, as we would hope, right, that the Federal Reserve is going to be driven by the data. Of course, the problem we now have is that a lot of that data somewhat dated already, and by the time we get to the next conversation, they'll still be looking at somewhat dated data. That's a tongue twister there, somewhat data. But I think what we're most concerned about now with the Fed, right, is path forward. And Art, I know you were patiently waiting, as you had mentioned months ago now, patiently waiting on the Fed to just finally get it done. Well, here we are. What are you seeing on the horizon?
Yeah, I really like the way the Fed did what they did. And as John indicated, the way Chairman Powell explained it. There's so much speculation with respect, or has been so much speculation with respect to what they were going to do and when. Several weeks ago, there were concerns that unemployment was spiking, not enough people were getting jobs, and the Fed was behind. And Powell did a wonderful job, as John indicated, explaining how this is the right move at the right time. He didn't look back and say, no, we should have done it before. He's taken politics out of the whole thing. Again, it's data dependent. And I really like the way the Fed navigated this whole run. They're going to stick the landing, I would bet, but you can't speculate. But it's very clear that they're on their way to winning the war against inflation, and they've got their sights set on making sure the economy is strong enough to continue to create enough jobs so the economy continues to grow.
So can I ask my question? So we're 2 years away from when we had a 40-year high of inflation, and now, as John said, I mean, the Fed is signaling that maybe they're not saying mission accomplished, but they're saying, they're confident that it's under control. So what, if anything, should investors, especially retired investors, have learned from this episode?
To be patient, to understand it, especially the Federal Reserve. This particular Federal Reserve, I think in the decades I've been here, I think each chairman's done a better job. And they've had to take on significant challenges. I mean, you look at Bernanke back with the Great Recession, you look at Janet Yellen, thereafter, and now this guy who had to deal with a pandemic, to prop up the economy, and that's part of what drove global inflation to begin with. And I think to just have confidence when you have good people at the helm, they're going to get you through. Stocks go higher over time. Interest rates end up where they're going to be. The Fed's difficult mission, he talked about this in that press conference as well, is to determine what the neutral rate is. What is the right rate for short-term interest rates so that you're stimulating enough but not too much, and so that rates aren't so high that you're slowing, growth too much. And so you want to defeat inflation. I think they're there, but you want to keep things humming along. And there's no question, but with the stock market going up as it just did, it tells us that at least investors are confident. The market's a leading indicator. So what should your typical retiree do? Call us if they have a question.
But I mean, 40 years ago when it was that high, waiting was harder. It took a lot longer for those rates to go down.
Well, and I think we have to be clear that we're not at 2% yet. And when you look at the Fed's dot plot, their summary of economic projections, they're still talking about their typical inflation measures running a little hotter than 2 for the next year or so. Of course, that's a vastly different number than 8 or 9 or whatever number you were looking at 2 years ago to date. And so I think it's important for the recently retired to remember that we've built in an element of inflation protection into the way we talk about retirement income, right? That it isn't strictly, hey, take every penny you make and you'll never run out. It's, hey, leave a cushion for prices to likely go up a little bit down the road. And most importantly, not just all prices, but prices on the things that are probably going to impact you most. And so I think that's where sometimes the conversation has to go even a level deeper and go, well, yeah, you might not care as much about housing prices. The Housing Services Index, one of the biggest pieces of the current inflationary problem. You're going to care a lot more about healthcare costs, though. And so if we see food prices more stable now, if we see healthcare costs more stable now than they've been, well, okay, maybe the conversation shifts a little to, well, yeah, you're in your home. You don't need to worry about the housing pricing increases. But I do pay a little more attention for you to some of these other areas and what it means for your spending. And Art, we were talking before the show, I think you have found that maybe clients don't increase that withdrawal rate as much as we might otherwise think.
Yeah, the way we do planning, we always bake in a hedge against inflation. We expect that investors can, if they start with a reasonable draw rate, take out 4% per year, adjusted for inflation. I literally can't remember the last time one of my retired clients said, hey, it's time for my raise. And I can look back and see how much better people have done than we ever anticipated over the past 10, 20, 30 years, even if they've taken out more than 4%. So the price is going up thing, that's why we put money in the stock market. That's our hedge against inflation. And as far as medical expenses going higher, being one of a couple members at the table here, on Medicare, I don't notice it. Our insurance is covering off most of those expenses. And again, I find that for my retirees. Nobody's complaining. I mean, they might complain about, gee, inflation is high. What are we supposed to do? One of my clients, a very wealthy individual, indicated, geez, I'm finally starting to feel inflation. My country club dues went up. And it's costing more to eat out. Well, I mean, if you're paying $200, $300, $400 a meal, yeah, you might notice another $50. I don't think so. You're just spending that kind of money to begin with. And so again, it's just you have to be patient when we go through these periods of time in which something happens, and that's all this has been. But I feel so good about what the Fed has accomplished. We had a pandemic 4 years ago. What are people thinking? Okay, are you better off now than you were 4 years ago? Are you kidding me? They opened the doors. We got to get out of our houses.
I think it's reasonable, though, to point out that while household values are up, the value of your home, household net worth is up substantially, your 401k balance or your IRA balance is up substantially, and even wages largely have gone up, inflation adjusted, pretty substantially now recently. There is still a pretty big wealth divide out there in certain areas of the country. And so I think there are some places where they feel it, and I think that's reflected sometimes in how we see spending in some areas with retail sales and consumer spending, such important pieces of the economy overall. It's why we keep such a close eye on it. And, of course, Joel, we had retail sales this week. I think a slight move higher on the number month over month, a little bit of a revision in the prior month, but showing signs that maybe the economy isn't quite as hot as what we might be cheering otherwise.
And it's not as cold as we might be fearing. So we did have an increase in retail sales in August, and only 5 of 13 retail categories actually advanced. So that's showing a little weakness there, but they still overall advanced. And, we always talk about how important consumer spending is to the economy overall. And remember that the Fed felt confident about starting to lower interest rates because they're concerned that they don't want the economy to be too constrained. But it's not constrained so much that it was cutting in on retail sales.
Which I think is healthy, and of course, Art, you mentioned the kind of neutral rate of interest, the Fed's kind of preferred measure for where do we find that rate policy is neither restrictive or accommodative, and we're a long way away from accommodative. But Joel, to your point, well, we also aren't as restrictive as maybe we otherwise thought because the economy is still growing, and I think that's the encouraging thing to me when we look at some of the economic data is this far along into the rate cycle and now on the tail end of, okay, the cuts have began, I would have expected a lot more softness. I would have expected a lot more signs of weakness than what we've seen. Doesn't mean they can't come. Certainly there are places that we need to be sensitive to. There's things we need to keep an eye on. But, when I look at the economy broadly, I'm pretty encouraged.
I'm going to make a prediction here that this rate cut is going to stimulate the economy. That's what the Fed is banking on, and I think it's at a good time. And as we talked about this wealth gap, lower short-term rates help the borrower big time, especially those who have revolving credit. So you're going to have people, whose credit card balances have gone up, who are paying higher interest. Their interest rates are going to go down, and they're going to see that on their statements. They'll probably spend more money over Christmas. And the Fed is pretty much, as you've indicated from their dot plots, suggested that they're going to lower rates a couple more times this year. Probably 0.25%, but you're going to get speculation on that. And the other interesting thing I find, and you're obviously on top of that as well, the yield on the 10-year Treasury. Now, it went up a little this week. That's not bad because it's gone down in anticipation of these moves. This is about as normal as this economy's been since before the pandemic. So I'm cautiously optimistic that you're going to see more people spending money at Walmart, among other places, and this will help people traveling. I think it'll stimulate the economy. That's exactly what the Fed's trying to do.
And just a reminder that before the pandemic, the economy was doing pretty well.
Absolutely.
John, a few weeks back we were talking about interest rates and how if we see a little bit more movement, we might potentially see some better prices. And Fed action on rates maybe softens up the mortgage rate as well, and that might help people looking for houses.
And that's kind of another point that Powell made is after his remarks answering questions, one of the questions was specifically about the housing market, and he remarked saying that demand has stayed strong, but the supply for houses has been kind of the sticking point over the past few years. And he said that that's partially, well, mainly because of mobility, and the rates coming down allows people who own houses to be a little bit more mobile. And they might be more willing to move out of their current house if they can, get a mortgage for less than 8%. That's kind of been floating around the past year and a half. It makes it a little bit more willing to do so, which hopefully increases the amount of houses that are available.
And another aspect of that is just the inventory, the number of houses out there to begin with. And there's we always have show notes that we publish with the podcast, and there's a graphic in there looking at housing under construction, and it actually reached a peak. I mean, an all-time record a couple of years ago, and it's down from that now, but it's still higher than it's been in the last 50 years. And if you look at that graphic, it'll show what a nosedive housing took after the Great Recession. And it was just starting to get back to a point where it was before the Great Recession when the pandemic hit. And so we're still above that now, but it's going to take years to catch up.
But we will. We will. I mean, this interest rate, this is a big deal this week. And this is a shot in the arm of this economy that, quite frankly, wasn't sick. So it's just going to get this economy going even better than I think it is right now. That's my prediction. I think that's why the Fed did it, without really fanning the flames of inflation, or they wouldn't be doing what they're doing. And the softness in the labor markets, I think they're going to solve that. The housing thing, you just did a wonderful job talking about how that, I think, can improve because mortgage rates are going down. Builders can borrow money cheaper. They can pass on their lower interest rates and subsidizing, interest rates for people who are buying homes. We got a client in Texas who's benefiting from that already from prior, interest rate, declines in the yield on the 10-year Treasury. So we are at a very good time, knock on wood. Let's keep it going.
Well, and I think if we are looking at the housing data, it's worth kind of pointing out it was a big week for housing data as well, Joel. We had not just housing starts, which included that housing under construction number, but building permits, existing home sales, entering the time of year in which that stuff normally starts to slow down a bit because it's not always the greatest weather to build a house or go looking. But I still think it's a pretty important kind of benchmark for how that part of the economy is doing.
Yeah, Kyle, both of those for housing starts and building permits, they are back to where they were, maybe even a little below, I guess, for housing starts, but they're around where they were back in February of 2020 before the pandemic started. And again, that was the highest that we had seen those categories since before the Great Recession in 2008.
And I think, again, housing is such a critical piece of the economy overall because if you're buying a house, especially if you're buying a new one, first-time home buyers, you probably need to fill that house with refrigerators and couches and beds and all the other things that come along. And so if we are talking about the core kind of piece of our economic activity, well, housing is one of the big drivers of it. And so I think if we are concerned about the direction of the economy overall, so far the Fed isn't. When you look at the summary of economic projections, they're mostly forecasting the next couple of years that economic growth is weak but stable. And when you look bigger picture, say at the earnings piece, Art, I know that's something you pointed to in some of your pre-show notes was, hey, the earnings opportunities out there, especially through the end of this year, look pretty strong. But even going into 2025, the earnings outlook looks pretty strong.
Yeah, and that's why we're in the stock market to begin with. On a cautionary note, again, with the S&P up over 20% for the year, I said it several weeks ago that you could sell everything you had, stick in a money market, and still have a positive year. You would have avoided a little of the volatility we had in between, but here we are again in record territory. So, I do anticipate that times are going to continue to be good for investors in the stock market going forward because we're getting into this earnings season, and companies tend to understate what they anticipate for their earnings, and so they typically report higher earnings than the analysts have expected, and so I think stocks could go higher. This is an election year. We have to worry about volatility incident, to that. On the other hand, for savers, I want to talk about this other thing. Okay, so here we were getting 5% or more in money markets. Okay, boom, you just got a 0.5% haircut. I don't have enough hair to worry about that, but another 0.5% by the end of the year, we're going to be down to the 4s easy. Within a year, we're going to be down to 3.5, but that still beats inflation. So cash is still providing savers good returns. We had no returns, for a long period of time. So yes, earnings season could be good. Fasten your seatbelt. There's always speculation out there. Lower interest rates give speculation the ability to borrow more and speculate more. So I think we can anticipate further volatility. But yeah, as you suggest, higher corporate profits this year, next year, maybe baked into prices a little bit already. But for my money, the money I have in the stock market, I expect to grow over time, not at any particular time.
And time is key, right? That if we are entering a universe in which, or an environment in which things are going to be more volatile because of war, because of election, because of whatever, well, yeah, those aren't going to be the same problems that we're dealing with 5 or 10 years from now. Maybe we'll deal with some of them again. Maybe some of them will still be on the docket, but there's going to be plenty of new problems then. And so if all you ever do is look at, well, here's the things we're concerned about, you miss all that opportunity. And so I think you are spot on when you say, yeah, the earnings forecasts are maybe a little understated for kind of what the near-term earnings look like. I also think, again, when we look at the longer-term opportunity, we're entering an environment in which there's a lot of change, there's a lot of kind of development going on that's going to drive not just earnings growth, but potentially some economic growth as well. And in my mind, that's a pretty happy place to be a stock investor. Yeah, it comes with that uncertainty, but ultimately, again, that's the price you pay to invest in stocks. Joel, one more maybe piece of economic data this week that stood out to me, industrial production. It's been a bit up and down on that front. A lot of time of year changes, especially coming through the summer with summer shutdowns, and so a lot of noise. But overall, manufacturing sector seems to be on solid footing as well.
Yeah, if we look at industrial production overall, and we don't look at the month to month, which gets a little bumpier, year to year, there was no gain. It was the same amount of industrial production that we had a year ago. And again, take that as a win because the Fed has been trying to slow down the economy, and as far as that one number is concerned anyway, it's at a standstill. So that's not bad.
That's not bad. And maybe the tagline for this year's seminar, that's not bad, coming up October 1st and October 9th. If you haven't already signed up, we'd love to have you. I think, the kind of general consensus from the week is that we more or less got what we expected. Yeah, maybe it was a little bigger of a cut than what some were thinking, but certainly 0.5% to 2 quarter-point cuts all at once were on the table. And so excited that the market seemed to respond favorably, excited that we're now on the tail end of hopefully what was a pretty rough period for inflation. And I think, again, if we look at the road ahead, I'm fairly optimistic about what it means. Thanks for listening. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.